Well, it's an important question, and I think the most important thing to say, first of all, was that first rate hike was very well anticipated. The markets were expecting it for a very, very long time. Now, going into the start of 2016, the Fed was signaling 4 rate hikes.
Yes.
The market is now pricing in 2. They were pricing in 3, now the market is pricing in 2. So really 2 or 3 rate hikes is what the world is really thinking about right now. But given how bad the start of the year has been, it could be quite a challenge even to get to 2. So really the Fed is going to have to look at the data, look at the impact of all the volatility around the world, look at what the Chinese are doing, and try to reassess its own growth prospects. The last non-farm payroll number was a strong one, so it indicated that the US economy is creating jobs and things look fine, but I think they need a bit more data to make the decision whether they go in March. So this next month and a half will be very important for the US. I think the first thing to note is that they were doing this during a period of a lot of global volatility. So we were expecting rates to gently go up through the course of 2016, not dramatically, but just to rise gently over the course of 2016. I think that's what the markets were expecting as well. But what actually happened really since then, that rates have come down. And a lot of the markets around the world have experienced a lot of volatility, equity markets, currency markets, and people have had to buy more government bonds to protect themselves. So government bond markets around the world have actually come down in yield at the start of the year. That's why the impact has been a bit of a shake for the world. I think, to be honest, this outflow and this risk off for emerging markets more broadly had been going on for a very, very long time. This wasn't just related to the Fed. It's fair to say that the growth rates have been disappointing in emerging markets. The oil price fall has really hurt a lot of the exporters like Russia, like Brazil, like the Middle East, and that's fed through to markets. And in general, the demand curve for commodities from China has been so much lower that all the other commodity producers have been hurt as well. So, it's not just the rate hike from the Fed that affected markets, but really a slower growth for the world economy, commodity risk, currency risk. There was a lot of things going on at the same time, but I think the Fed hike and expectations of higher rates going forward have made investors more nervous. So we think 2016 will look a lot like 2015. We're hoping that growth will be a little bit better than 2015. But the truth is, it's going to be a challenge. Even the other global financial institutions, the IMF, the World Bank, have all lowered their growth projections. And 2.6% for the world economy. It's not a recession, but it feels like a recession. It's not very impressive growth, and it's going to take a miracle for the growth rates to go up. Now, to offset that, last year, over 40 central banks around the world cut rates, and the Fed looked to hike rates. So there's a bit of an imbalance around the world. So we need to watch the data very carefully to see whether central banks can do more. Can they cut more rates? Could the BOJ do more QE? Could the ECB do more QE to help? But these are the challenges right now. It's a really, really tough time for the world in terms of growth. Obviously, cutting rates means you kind of want a weaker currency as well. And right now it's hard to find a country that really wants to have a hard currency. Only really the dollar stands out as a currency that is strong, that people want to own, and everyone rushes to in times of uncertainty. And with the Fed still thinking about hiking rates, and everyone else trying to accommodate, it's going to be a very, very tough period for the dollar. In other words, a strong dollar will make it tough for other market participants. So the truth is that most central banks around the world, given the deflationary pressures, are probably looking to cut rates more. And really the Fed is the standout big central bank that wants to hike. And that's why we have a very, very strong case for being dollar bullish. And a lot of other currencies around the world will be struggling against the dollar. And again, the more other countries want to cut their rates, we expect them to underperform against the dollar. And I think the examples would be, there's Korea in mind. There will be, Thailand wants to cut rates too. There are lots of other countries around the world that are doing the same kind of thing. But we have a view that the Asian currencies in particular, and China is another, probably the best example really, that are looking to loosen monetary policy, cutting more rates, and allowing their currency to weaken a bit more. They're the big examples, really. Well, the capital flight that we've noticed, a lot of it has gone to bond markets to find a bit more safety. Some people have chosen to keep it in cash. But it's very early to tell where global capital flows are going to go in 2016, because we know there was a lot of money that left China, and we knew a lot of investors have gone to the dollar. But now with the oil price falling to such a low level, it'll be interesting to see how capital flows evolve after all of this, because maybe there'll be countries and there'll be companies that need to meet demand for dollars. They actually have to pay for their stuff in dollars. So what they do and how they chase the dollars around the world will be the news story for 2016.
Okay.
The first place of safety will be US Treasuries. That tends to be the first port of call when things are very nervous around the world, or when the volatility is high. European government bonds can also be a zone of safety, but they don't offer much of a yield. I mean, if Germany yields 50 basis points and the US 10-year is 2%, you probably choose the US bonds over the German ones. But I think most investors, if they are locally based, will go to the local government bond market for safety first and foremost, and then they'll consider things away from their own currency if things get even more uncertain.
But the price of the bond market is different in each of the country, right? Depends on like the currency as well, and then the government or the policy from the central bank.
Yeah.
Is it different?
There are, but the main thing to note right now is that the Bank of Japan is doing a lot of QE, the ECB is doing a lot of QE, the Americans are not doing any QE, and lots of central banks around the world are trying to cut rates. So really, if you want a zone of safety, people have looked to the US, they've looked to the dollar, because they are the most liquid and deepest and largest government bond market, and the one that offers value as well. And they're backed by a stronger dollar. You look at those things, that makes the dollar and those assets more attractive.
Okay. Lastly, could you give us some investment strategies throughout the 2016?
Yeah, I think the best one I can give you is a focus on credit markets, a focus on corporate bond markets, and we're certainly seeing lots of value in the corporate bond world. Certainly over the course of 2015, beginning to 2016, valuations have become attractive. And we certainly would urge investors to think about asset allocation decisions, perhaps taking some capital away from equities and putting it into corporate bonds, and potentially if in developed market bonds, putting some of those bonds into capital securities for companies too. Now within credit, there are three things that we think are very interesting. The first one is bank capital securities. This is the debt of banking institutions. So bank capital offer yields of anywhere between, let's say, 5.5% and 7% in dollars, globally diversified. The second strategy is income strategies. Now we have income strategies targeted that offer between 5.5% and 6% return. They have some high yield component, they sometimes have emerging market securities, but they are a globally diversified pool of income securities. They also have non-agency mortgages, which we still tend to like. And the final area is really the case for global credit in general, in particular investment grade. So we're looking at these kind of securities, and we think that if US 10-year offers you 2%, these securities may offer you 4.5%, 5%. Roughly, that's an example in global credit. So we urge investors that don't have these securities to think about asset allocation towards the credit markets.